If your money only moves when you do, you're not an investor. You're an employee of your lifestyle. The lazy investor flips that script. Build once, maintain lightly, and let systems collect while you sleep. By the end, you'll have a blueprint that pulls cash into assets automatically, compounds without your opinion, and protects you from the one threat no portfolio survives: your own impulses. Start with the triad that runs on autopilot. Capture, allocate, contain. Capture funnels fresh income into investments before you see it. Allocate puts those dollars into broad, low-fee exposure that wins quietly over time. Contain adds guardrails so you can sleep when markets don't. Capture. Pay yourself first the day after payday. Set an automatic transfer from checking to your brokerage, retirement account, or robo. Same date, same amount, every month. Add an auto escalator. Increase contributions by 1% each quarter until it pinches, then hold. Remove decision friction. Money that misses the train rarely catches up. Allocate. Default to a one-decision portfolio. Use a target date or all-in-one balanced fund. Or build a simple three-fund stack: total world stocks, total bonds, and cash. Keep fees microscopic. Termites eat houses slowly. Global equity for growth. Investment-grade bonds for ballast. Cash for flexibility. Turn on dividend reinvestment so every distribution buys more engines. Automate dollar cost averaging. Same day, same buy, regardless of headlines. Your job is to show up. The market's job is to be moody. Volatility becomes inventory when you purchase on schedule. The lazy investor doesn't predict, they collect. Contain. Install the safety floor. Hold 3 to 6 months of essential expenses in a high-yield savings account or a rolling 3-month T-bill ladder. Automate replenishment after draws. Pair it with must-have insurance, health, disability, liability, so a single event can't liquidate your future. Set a risk band you can sleep through. Pick a baseline mix, say 70-30 stocks to bonds. Then define guardrails like 60-40 on the downside and 80-20ths on the upside. When markets push you outside the band, rebalance back inside. That's one maintenance task per quarter or semi-annually, calendar-driven, not headline-driven. Write a one-page policy for your future self. It answers 3 questions: how much you invest and when, what you buy and why, and what will make you sell. If it's not in the policy, no action. Boredom is not a signal. The triad does the heavy lifting. Money is captured before it leaks, allocated without angst, and contained against chaos. In the next section, you'll add accelerators, legal shelters, tax-smart ordering, rebalancing rules, and contribution flywheels that make a set-it and semi-forget-it plan outrun most active traders, with far less effort and zero heroics. Before you move on, capture one quick win tonight. Set the transfer amount, pick the default fund, and write the first draft of your policy in a text note. Momentum beats intention. 5 minutes now creates 5 figures later. Tomorrow, you'll learn how to keep more of every dollar the system earns by routing flows through wrappers the taxman quietly incentivizes for you. Start with order of operations. Collect all the free money, then the biggest tax gifts, then the flexible accounts. If you have an employer match, capture every dollar. A 100% instant return is the laziest win you'll ever get. If you're HSA eligible, fund it next. It's triple tax advantaged, deductible on the way in, grows tax-free, and withdrawals for qualified care are untaxed. Many lazy investors treat the HSA as a stealth retirement account. Invest the balance, pay small medical bills from cash, and let the HSA compound for decades. Next, fund an IRA in the flavor that fits your bracket. Early career or temporarily low income. Roth buys you tax-free growth forever. High bracket today, with likely lower taxes later. Traditional can cut your bill now. High earners can still route dollars into a Roth via the back door. If you're self-employed, use a solo 401k or SEP to raise your shelter ceiling. After you've maxed the tax-advantaged lanes that apply, push the overflow into a plain taxable brokerage where you can withdraw anytime without penalty. Now place assets where they're treated best. Broad equity index funds sit well in taxable accounts thanks to qualified dividends and long-term capital gains. Bonds throw off ordinary income, so hide them in tax-deferred accounts when possible. REITs belong in shelters too. If you insist on bonds and taxable, Consider high-quality municipal funds if you're in a high bracket. But remember the prime directive: simplicity beats precision. One all-in-one fund inside each account is perfectly fine. Rebalance by rule, not by headline. Calendar-based is safest. Pick 2 dates a year and adjust back to target. Threshold-based is smarter. Use the 5-25 rule. Rebalance if a slice drifts by 5 percentage points absolute or 25% relative. Prefer cash flow rebalancing first. Direct new contributions and dividends to the underweight asset instead of selling the overweight one. This keeps taxes and trading low. In taxable accounts, add one more lazy edge: tax loss harvesting. When a fund drops below your purchase price, you can sell to capture the loss, buy a similar, but not identical, fund, and keep your market exposure. Losses offset realized gains and up to $3,000 of ordinary income per year, with the remainder carried forward. Avoid wash sales by not repurchasing the same fund within 30 days across any account. Most robos can automate this. Your policy dictates when. Install the contribution flywheel. Every raise auto-escalates your savings rate. Bonuses split by rule. A fixed slice to investments, a fixed slice to joy, a fixed slice to debt or reserves. High-interest debt is negative compounding. Automate extra payments until it's dead. Put bills on autopay. Use a simple 2% cashback card paid in full, and send the rewards to your brokerage monthly. Small frictions removed, big outcomes preserved. Finally, protect the system from you. Institute a 30-day cooldown for portfolio changes not triggered by your policy. 1 monthly dashboard. Savings rate, allocation, cash runway, next upgrade. Consistency is the strategy, always. Now layer in resilience and quiet acceleration without adding work. Diversification is your bodyguard. Keep the core simple, then add small, rule-based satellites you can ignore for months. Real estate exposure? Lazy investors buy broad REIT funds inside tax-advantaged accounts, collect rent by proxy, and skip midnight plumbing calls. If you own a home, treat fixed-rate debt as a negative bond. Paying it down guarantees a return equal to the rate. If that rate is high, accelerate it. If it's low and fixed, inflation quietly repays it. Invest excess instead. Don't chase income. Engineer cash flow. Yield is not a strategy, total return is. High dividends often signal slow growth and higher taxes. Set up an automated monthly withdrawal from your brokerage when you need spending money, and let the portfolio sell tiny slices across assets according to your rebalancing rules. That way, you live off the whole engine, not just the loudest exhaust. Plan for sequence risk before you need it. Build a 3-bucket glide path for any multi-year goal. A cash bucket covering 1 to 2 years of spending, a bond bucket for the next 3 to 5, and equities for years 6 and beyond. Refill the cash bucket during good years and hold steady in bad years. Use a guardrail spending rule. Give yourself a raise when the portfolio rises above the upper band, and cut withdrawals slightly when it falls below the lower band. Systems absorb shocks better than courage does. Put curiosity in a sandbox. Allocate 5 to 10% to optional tilts, small cap value, global ex-US overweights, a rules-based momentum fund, even a tiny slice of venture or crypto if you must. Write the thesis, the risk, the exit, and the maximum allocation. Expect tracking error. Never rescue a loser with fresh emotion. When the satellite grows, skim gains back to the core. Control single stock risk. Cap employer equity and any individual position at 10% of net worth. Concentration feels exciting until your livelihood and portfolio depend on the same company. Diversify before you're forced. Install a lazy calendar. Quarterly, check savings rate, rebalance if outside your band, cancel stale subscriptions, and raise automatic contributions by 1%. Annually, review insurance, revisit your one-page policy, harvest losses or donate appreciated shares, and confirm beneficiaries. 10 minutes beats 10 opinions. Simplify relentlessly. Complexity is a fee you pay in hidden mistakes. Most investors can win with 2 to 4 funds, automated contributions, a cash runway, and a written policy. The edge isn't secret picks, it's discipline visible in your calendar. Your blueprint is now live. Capture income automatically, allocate to low-fee engines, contain risk with buffers and rules, keep more through smart wrappers, and protect the system from you. Set it up once, nudge it quarterly, and let compounding do the heavy lifting while you sleep. Tomorrow will arrive whether you invest or not. Choose the version of you that wakes up already wealthier. Start today, automate one transfer, and let your future self send the thank you note.